I'm Benjamin Beaver. Let's talk about VA loans. Okay, so VA loans. VA meaning Veterans Affairs. So this is a loan for military or former military, an option that civilians wouldn't necessarily have. And what it really is a zero down loan. So because it's backed by the Department of Veterans Affairs, meaning if you don't make your payments to your lender, they're insured by the government that the government will take over the loan if you're in default. And so they have a high degree of confidence to offer you this loan. And if you qualify for it, you can potentially do zero down. That doesn't mean you're not going to have closing costs. So when you're buying a house, you have your down payment and then you have your closing costs. So closing costs, another way to say that is like loan related costs, because if you're buying a house for cash, your closing costs are going to be pretty minimal, just some title fees and all of that. So your closing costs for a VA loan on say $200,000 could be somewhere around $6,000. You may be able to negotiate the seller to pay your closing costs and get a truly zero down purchase experience. That can happen, but regardless, your down payment can be zero. There are some other things to consider. So when you're doing a VA loan, the appraisal is going to be more strict because, anything government backed, they're going to have a little bit of red tape for us. So there's going to be a higher standard for the appraisal. The house has to be obviously in generally good condition. Everything has to be working. A lot of times when we have an issue with a VA appraisal, it's because the house has peeling paint or something like that. Something curable, something that we can solve. But it's something the seller will consider, because if they have multiple offers and yours is VA and the other's conventional and everything else is the same, they might go conventional because it's just a little bit easier for them. So that's something you have to keep in mind. The other thing a VA loan has that other loans don't have is a funding fee. Because the loan doesn't have mortgage insurance like an FHA loan, they're going to have a fee that they can roll into the loan up front. So if you're going to be selling the house within a year or 2 years, you have to consider that funding fee because it's going to hurt your equity a little bit. But if you're going to keep it long term and you're not having to have mortgage insurance, then it may come out in the wash and be better for you. But there's a little more to understand about it, but that kind of gets you started.